Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Altus Group is a star performer in Toronto today. The company has announced plans that include $500 million worth of share buybacks and reviewing its non-core products and services for potential sale. Altus also plans to pursue a secondary dual listing in the U.S. market in 2027. It will maintain its listing on the Toronto Stock Exchange as well. Stella-Jones, also one of the better performing stocks on the TSX today, that after the Canadian Wood Products Company introduced new 3-year targets. The objectives include organic sales growth of up to 5%, profit growth of more than 10%, and a goal to reach about $4 billion in annual sales by 2028. Analysts see the new targets as an encouraging sign of expansion. Shares of Walmart are trading higher. The retail giant boosted its full-year sales outlook after beating estimates in profit and revenue for its latest quarter. Walmart also reported growth in its e-commerce segment and is incorporating AI across its operations. It's teamed up with OpenAI so shoppers can purchase products on ChatGPT. And as for the markets, they started off with a boom. Now it's a bit of a bust. You can see the TSX is off by 0.96%. And in the U.S., also, everybody down right now after starting off up over the NVIDIA news. The S&P 500 off by 0.8, the Dow Jones down by 0.56, 0.54, and the Nasdaq off by 1.12%. Now, earlier it looked like the bull run was back after that blockbuster quarterly report and forecast from NVIDIA appeared to restore investor confidence in the AI trade, but it seems to have changed for the afternoon. Let's welcome Martin Pelletier, the Senior Portfolio Manager at Trivest Wealth Counsel with Wellington Altus Private Counsel. Martin, thank you very much for joining us.
You betcha. Thanks for having me on your show.
What's going on right now today with the market? With what we saw with NVIDIA, it seemed like what everybody was waiting for, and now markets are off.
Well, if you think about, we're having a little bit of seasonal weakness here. You have some profit taking. If you look at NVIDIA, for example, you had a news of Peter Thiel, Bridgewater, and others taking some profit, even some insiders selling ahead of the quarter here. 2/3 of the S&P components are actually in correction territory, being down 10% or greater. And so the index is actually holding up okay, down 2.5% so far this month, simply because the banks are holding in well, and you have companies like Apple and Google that are doing very well. The Nasdaq's off over 7%, the Meg 7 are off over 7.5%. Bitcoin's off over 20 to 25%. So I think the big question is this the beginning of an AI bubble bursting, or is it the market taking a breather? I think the market's taking a breather. I think we've had a heck of a run this year. We're getting towards year end. You're having some tax loss selling. You're having some profit taking. You're having some rebalancing of portfolios. And we're seeing that in the weakness that we're seeing today and probably over the next couple of weeks.
And what's giving you the confidence that it isn't a bubble for AI?
You look at market liquidity and you look at the Federal Reserve and the supporting of that liquidity. Credit markets are one area that we really like to keep an eye on, because credit markets will tell you whether there's some issues that are lurking beneath the waters. Credit markets are okay. They're fully functioning. You look at Oracle, their debt has been hurt. And their credit default swap rates have been impacted. But on the flip side, you have Amazon, where they went to the market to raise $12 billion. It was 5 times oversubscribed. They raised $15 billion, and their rate are at a slight premium to U.S. Treasuries. So the credit markets are telling you that everything is looking okay.
And so no concerns about that, those bond sales?
No, like I said, the U.S. Debt market is also being supported by the Federal Reserve, and they've announced that they're going to step in and support the repo market by directly purchasing front-end loaded T-bills being issued by the U.S. government. That's also a positive. On the flip side, you have concerns about a rate cut in December not happening. I think it's priced only now 30 to 40%. So that could drive some further weakness in as we get to that Fed rate decision. But broadly speaking, look at the NVIDIA results. Look at some of the results we've seen from Walmart today. Even if you're looking at other segments like Lowe's, there are companies that are performing very well. On the flip side, if you look at the K-shaped economy, there are segments of the market that aren't doing very well: Nike, Target, Home Depot. So we're in a good old-fashioned stock picking market, and I like that.
And what does that bode then for the rest of the year?
I think we're going to see some weakness for the rest of the year, and portfolio managers have met their targets for the most part. And why get greedy? Let's just take some money off the table, rebalance, de-risk portfolios. But I think we're going to have a little bit of continue. And you can see that today with I expected this rally to continue today on what we saw from NVIDIA last night, but it gave it back right away. So it's telling you that we're probably going to see some weakness over the next little while here. But having said that, I think we're going to see some strength in early 2026. I don't think this is the bursting of the AI bubble.
So these last few months of the year are really going against the grain. I mean, September, there was no real drop. October, and now we're seeing it now. I mean, we probably won't see a Christmas rally.
Who knows? There could be something that that comes out of left field to cause like we saw in NVIDIA. But yeah, I'm not seeing. I mean, I think Christmas just came early, and we just got our presents in September or October instead of December.
Oh, well, it's not a bad thing. The weather was nicer, so who can complain about that? Any concerns about the U.S. labor data? We saw the numbers for September, 119,000 jobs added, but we're not going to see the October numbers. Is that going to be a factor, that the not knowing?
Yeah, there's just that uncertainty. I think the Fed is going to act in light of that uncertainty. Why would they want to cut rates in this kind of environment with a lack of solid data? I really do believe that the Main Street average consumer is struggling with affordability. You're seeing that in the polarization with, for example, the election of Mandami in New York. There's a whole swath of the population that don't own assets, that haven't benefited from the asset inflation, and they're hurting and they're struggling. And you can see that in Target's numbers, see that in Home Depot's numbers, you see that in Nike's numbers. And those companies have been able to shift to electronic online purchasing and such, like Walmart, have done a really good job reducing their costs and maintaining their margins. So we're seeing those who aren't adjusting to the new paradigm we're in with this K-shaped economy suffering in their share prices.
Okay, we're going to have to leave it there. Martin, thanks, though, for joining us.
You betcha. Thank you. And reporting from Mount Royal University here in Calgary. Thank you.
All right. Cheers, Martin Peltier, Senior Portfolio Manager at Trivest Wealth Counsel with Wellington Altus Private Counsel. Coming up, we're tracking shares of NVIDIA, of course, after the chip makers' third quarter beat. Stay with us. More reaction. Despite reporting a third quarter earnings beat and stronger than expected fourth quarter guidance, shares of NVIDIA are trending to the downside. Investors appear to be jittery about big tech's massive spending on AI, and worries persist about an AI bubble. Let's get perspective now from Francisco Bido, Senior Vice President and Portfolio Manager at F&M Investments. Francisco, thanks very much for joining us.
Thank you.
Is this what you expected from the markets and from NVIDIA today? It's off by about 1.88% right now.
Actually, yes, I did expect that kind of reaction. Probably not as bad, but at least I think the market is a little concerned with, and when you hear people talking about AI bubbles and things like that, then that's a cause for jitters. And, even with the strong numbers that NVIDIA reported yesterday, I believe that the market is still nervous overall. And, no real fundamental reason in the case of NVIDIA, because they, as you see with the numbers, the business fundamentals are strong. Yeah, they're strong way into 26, 27, but there's still talk about a bubble. And that's why you see the jitters.
What would alleviate those fears? Everybody thought that NVIDIA's third quarter results, they beat estimates. We thought that would be enough. But what more do people want to see now?
Well, I think they want to see more of the same from everybody else, honestly, obviously, right? But I think that's still not going to calm the jitters. Fact of the matter is that the market had a really great run with the AI stocks in 2025. And it's about, it's normal for a healthy market to take a pause sometimes. It just can't go up forever. I won't call this the beginning of a correction or anything like that, but it could be a little bit of a pause.
It feels like that. We were just talking about it. It feels like Christmas came early. We saw it in September, October, and then
that's right.
There's not going to be a little rally coming up.
Well, there might be a little Santa rally or next year. We'll see how that goes. A lot has to do with the uncertainty in the macroeconomic environment. We just got the September numbers. That's unprecedented. We should have current numbers. But anyway, that's just one of the aspects, one of the details there. If we see some stability, that's all we need. Just, some stability in the macro environment, and things should be fairly dandy in 2026.
And going back to those numbers, the September numbers were okay, but we're not going to see October. Will that be a factor, or is that kind of rolled in with how everybody's reacting?
No, it's going to be a factor. I mean, it's hard to feel, by its nature, markets are uncertain. And when you add more to the uncertainty level, it's not a helpful thing. Let me put it that way. So missing that number, it's not at all constructive.
Okay, and this one, I won't go back to NVIDIA because that's what everybody is talking about. Some of the looking ahead, one of the things they said that China, their numbers were zero. Or what they were looking for. How much of a factor will that play for them? Are they missing out on it? Do they need China, or can they get by without China?
Oh, they can get by without China just fine. And I think it's been in prices for a good several quarters in the past. So that's factor in prices as you see them today, in my opinion. So I'm not too concerned about that. And if China does turn out to be a positive contributor to their revenues, that's a little icing on the cake there. Any
concern that NVIDIA could end up as a bit of a pawn between the U.S. and China?
That's who knows, but I'm not. That's nothing that I certainly actively modeled with, or I rather that be reactive to that situation than get too far ahead of myself. That's we'll see how that goes.
And and any other potential headwinds? One of the things I know people have talked about is not being able to meet demand either via power or production. What are your thoughts on that?
Well, NVIDIA's job is to sell the chips and let somebody else worry about the power. So, it is a concern for some of the cloud businesses out there, but I think they can, it's not in the top of the list of my concerns. Some of the bears will argue in that sense, oh, they're using too much power and they're going to be blackouts. What do they call it? The AI blackout or something like that. I'm not concerned about that.
Okay, Francisco, thanks very much for joining us.
Thank you. Appreciate it.
Cheers. Francisco Beto, Senior Vice President, Portfolio Manager at F&M Investments. Coming up next, the delayed September jobs data revealed that the U.S. economy added 119,000, but the unemployment rate increased to 4.4%. More on that after the break. The U.S. economy added significantly more jobs than anticipated in September, according to the long-awaited jobs report that was delayed due to the government shutdown south of the border. This will be the final jobs report released by the Bureau of Labor Statistics before the Federal Reserve's policy meeting in December. Let's welcome Olu Omodunbi, Chief Economist at Huntington National Bank. Olu, thank you very much for joining us.
Thanks for having me, Roger.
119,000 jobs added, a good number, expected number. Where does that stand?
Yeah, so the jobs report came in better than expected. Markets were calling for about 53,000 job gains in September. We got more than double that number. But there are also some concerns in the jobs report. We saw an increase in the unemployment rate. The unemployment rate went up to 4.4%. That's the highest unemployment rate since late 2021. We also saw negative revisions to job gains in July and August. So job growth in July and August was revised down by 33,000. So overall, we are seeing a slowing in labor market activity. And we think that, this is the reason why the Fed cut rates over the next, in recent months. We think it's likely we get another rate cuts in a couple of weeks.
Now, we've seen the bets on that at 50%, sometimes as low as 40%. What makes you think they will lean toward a rate cut there?
Yeah, so we think there's about a 60% chance that we get a rate cut. So a few things. One, just the data vacuum over the past 6 weeks. Due to the federal government shutdown, we haven't gotten many official government data. And the jobs reports before the shutdown started pointed to a weaker labor market. So job gains have averaged 75,000 so far this year. Compare that to last year, it was about 170,000. Now, given the fact that we have had this data vacuum over the past couple of months, and today's jobs report isn't particularly reassuring because monthly job data is prone to revisions. We've had many big downward revisions for employment data this year. So we think it's most likely that the Fed is going to play it safe and cut rates by 25 basis points in a couple of weeks.
Are there any areas that were showing strength and areas that are showing weakness that are concerning?
Yes, one of the themes of 2025 has been narrow job gains. So we've had job gains in leisure and hospitality, also in the healthcare and social assistance sector. That's remained the case in September. We saw decent job gains in those two sectors. But besides that, we are seeing, either tepid job gains or declining employment in many other sectors, particularly the government sector. We've seen, much slower. We've actually seen a decline in federal government employment this year and states government employment this year. So that's an area of concern, particularly over the next couple of months when many folks who took deferred resignations from the DOGE cuts, many of those deferred resignations will start showing in economic data over the next couple of months.
Do we know, do we have any idea how many people who took the cuts, what the total was, and how many might be employed already, or is that we're going to have to wait and see?
Yes, I think that's a situation where we have to wait and see. But again, overall, the labor market is not collapsing. There's been a cooling on the demand side. There's also been a cooling on the supply side. So we saw a stronger increase from the supply side in September. That's why we saw the increase in the unemployment rates. And we think that we continue to see weakness from the supply side over the next 12 months due to aging demographics and also due to the current administration's restrictive immigration policies.
And with those, the aging demographics, just how big are we talking? I mean, that's always been a concern in Canada, and I imagine down in the U.S., the aging demographics. How much of a factor will that be?
Yeah, it is a big factor, but it's been a factor over the past decade, the retirement of baby boomers. Now, the way we dealt with that, the way we offset that was, was through strong immigration flows through 2023 and 2024. That's not going to be the case in 2025, and most likely not going to be the case in 2026. So again, it poses, downside risks to labor market activity next year.
And looking at the tech side and AI and all the talk of that, is that leading to jobs? Are we seeing job creation through that too?
Yeah, so we have seen many companies this year point to layoffs due to efficiency gains and due to AI. In our view, we think that we're still in the early innings of AI. Many companies are still in the adoption phase. Now, the great news is that there's insatiable demand for AI. But in the long term, we think it's also going to create value. And we think it's also going to create demand for workers. So in the long term, there will be disruption in the labor market as a result of AI, but we think it's going to be a net positive for the U.S. labor market.
Okay. Olu, thank you very much for joining us today.
Thanks for having me.
Olu Omodunbi is chief economist at Huntington National Bank. Coming up, after 36 years, David Chilton has released a new edition of The Wealthy Barber. We'll have more on that when we come back. The U.S. ambassador to Canada says Canada and the U.S. have a chance to reach an agreement to reduce tariffs. Ambassador Pete Hoekstra told a conference in Ottawa that talks will resume, but he's not sure when. U.S. President Donald Trump halted negotiations in October after Ontario Premier Doug Ford ran an anti-tariff ad featuring former U.S. President Ronald Reagan. We are watching shares of Northland Power. The company unveiled its updated strategic outlook for 2030. It's off by about 3.82% right now. Northland is aiming to double operations, focus on core markets, and narrow its organization from 3 regional hubs to 2. The company will focus on an Americas hub and an international hub. Northland says the shift is meant to simplify its structure and focus on resilience in the market. And of course, we are tracking shares of NVIDIA. It posted profit that topped estimates and revenue that surged 62% in its latest quarter, but right now it's off by about 0.5%. The chip giant also issued a strong sales forecast, pushing back on fears that the AI industry is in a bubble. CEO Jensen Huang also signaled that the $500 billion revenue target due in coming quarters may be even bigger than anticipated. NVIDIA has faced growing fears about unsustainable spending on expensive AI equipment. Now, initially, the markets reacted positively this morning, but they are off right now. The TSX down by 0.68%. South of the border, similar situation unfolding. Take a look at the numbers there. You see the S&P 500 down by 0.5 point, the Dow Jones off by 0.25, and the NASDAQ down by 0.7%. And after more than 36 years, The Wealthy Barber has been updated with fresh advice for the new generation. The first edition was published in 1989, well before NVIDIA, artificial intelligence, even TFSAs coming on the scene. Now the book has been completely rewritten to help young people navigate today's challenging financial landscape. To talk more about it is the author, David Chilton. Chilton, the author of The Wealthy Barber. David, thanks as always for joining us.
Great to see you. It has been a while.
You've been busy rewriting the book because...
Yeah, it took me 16 months. I was saying off air, it actually took me longer to do the full rewrite than to write the original because, of course, at that point there was RSPs. Now there's TFSAs. Now there's FHSAs. And not just teaching people what they are and their subtle nuances, but how do you prioritize? Most young Canadians certainly can't do it all. So which path do you take to optimize your situation, et cetera? And so it was tough. And then my writing process is very unusual. I keep sending out the pages to people in the target demographic, garnering their feedback, incorporating it into version 2, version 3, version 4. Seems like a good idea. I think it results in a better product, but it is overwhelming. And I'm old.
Well, that's what I was going to say. What's it like
old.
talking to them? 36 years ago, you were in the age group. Now you're talking to them and getting their responses. What was that like? What was their reaction?
It was interesting. One of the reasons I came back with the book was my kids are in the target demographic age, as are all their friends. And then, of course, my friends' kids are. And so you're constantly getting asked questions. You're seeing the mistakes they're making. And I thought, good time to bring the book back. The format obviously resonates. I didn't realize what I was biting off. I thought it would be 4 to 6 months, not 16. And at my age, that's a lot to give up. But I enjoyed it immensely. And I shouldn't say that. Actually, some days I didn't enjoy it. But I'm really glad the way it's
part of the process, right?
Yes.
What you mentioned some of the mistakes they were making. What are some of the new mistakes that young people are making compared to 36 years ago?
Well, it's tougher for young people, period. I mean, it's not just the cost of real estate. That gets all the media focus. But the cost of living in general is so much higher relative to incomes than it was even 5, 6, 7 years ago. Since COVID, we've seen CPI escalate. And I would argue that it doesn't properly reflect what's really happened to prices. It's even worse. But beyond that, you've got the algorithms constantly tempting you online and through social media. You've got ubiquitously available credit. This is not a good combination for consumers, and the young consumers are having trouble keeping up. The arithmetic is not there, and then psychologically it's tough too. So a lot of the book focused on those areas and was really quite empathetic. Like, I didn't try to gloss over the challenges. I got deep into the math and said, you're right, this is tougher. But in view of that, it's important, more important than ever, to do the right thing with what money you can save. And then there's also a long chapter in there about different savings tips and techniques you can use to make it somewhat easier going forward. And that chapter seems to really be resonating.
Now, sometimes if it's tougher, is there more opportunities because it's tougher, or is it not?
No, I think that's actually true. I mean, look at the new products, for example. Go to FHSAs. We didn't have them when you and I were young. I mean, what a product. Tax deductible up front, tax-free coming out if you use it to buy the home. Doesn't get any better than that. And then you've got ETFs. There's all kinds of products that make saving money, keeping costs low, a lot easier than what you and I had at 10, 20, and 30 years ago. But the overall situation is still more challenging, just the real estate prices alone. You look at their, 2.5 to 3 times a bigger multiple of income than they were 20, 30, and 40 years ago. Think about trying to save the down payment.
Yeah.
So if you're living in a Toronto, for example, and you're trying to get in at 6, 7, 800,000, let's just use 700,000, you're trying to hit the 20% mark, it's $140,000 you have to save after tax. Holy smokes. Choose your parents wisely remains very solid advice.
Yeah, it's a hard one to follow sometimes, though. I've heard, though, a lot of the younger kids now, or younger people, I should say, not kids, that's showing my age there. They're looking at that idea that they probably won't be able to own a home, and so they are focusing on the markets more. Did you find that with them?
I did, but especially with the males. And so I don't mean to sound sexist against men, but when you're doing all the research, you're reaching out and you're touching base with as many people as you possibly can, a lot of younger men, I'd say in their 20s, maybe up to 35 to 40, are taking pretty aggressive stances in the market. Sports gambling, of course, has made huge inroads in society. I mean, it's a huge issue. Let's not say it's not. And so those things together have led to very poor performance, despite the fact that the markets have actually been quite strong. And so instead of making things better by taking these aggressive stances, it's making it even worse still. But again, it tends to be almost exclusively a male problem, strangely. And the book addresses that pretty forcefully. One of the characters is drawn to all of that. And Roy, the wealthy barber, talks to him about the pitfalls, et cetera, et cetera. And again, the format is trying to put the questions and concerns the average reader has into the mouths of the characters so that people can relate to it, learn along with them. These are not math geniuses. They're not market experts. And I think that's why it works.
And that's men. What about on the female side? What are some of the issues you found with women when it comes to investing?
Well, they're living longer. We all are, but women even more so. But in general, women tend to be better investors. I mean, I know it's a stereotype, but all the data supports the fact that women tend to be more patient. Their holding periods for index funds, for example, tends to be better still. You know who it's tough on? Forget male, female, single people. Nowadays, because of the housing costs, whether it's rent or whether it's buying a home, if you're single, this is really, really tough. But you don't want to go out and just hook up with somebody and get married for all the wrong reasons. There's no easy answers to all of this, unfortunately. And therefore, again, my message is I can't fix all this. I can't just wave a wand and have it all go away. Let's make sure you do the best thing you can in these tough circumstances, that you save in the most efficient manner, that you watch your costs, et cetera, et cetera.
And with the markets itself, I mean, everybody's talking about the possible AI bubble, but it's also brought a lot of money in. What are you telling them? What do they do with that?
Well, again, my message has always been don't pay a lot of attention to the day-to-day. I like BNN, but my message to people is don't get too caught up in the noise and the news because you can't harness it productively. For the most part, you're buying monthly, you're buying index funds, you're focusing 20 to 30 years out. It's funny, when I was writing the preface to the book, one of my colleagues, one of my friends sent me a text and said, Dave, I love the draft, but what happens if AI takes over and wipes out all of our jobs? What position would you take then? And I said fetal. Because, I don't have a magical answer to that one. If we end up with 20 to 30% unemployment rates, it's going to be horrible for not just those people, but society as a whole. So where this heads in the next 5 to 10 years is going to be fascinating. And frankly, it's quite intimidating for all of us.
Okay, and now just talking about AI, staying with AI, ChatGPT, people are turning to that for all kinds of answers. Why go for the book over that?
Well, it's a good question. Number one, ChatGPT is not there yet. So I can tell all of your viewers, do not ask specific financial questions, especially if you're plugging in math and asking for that type of thing. Some of what comes back is very good, but there are many mistakes, sometimes significant ones. You still need an advisor. You still need to research this on your own. But I think the big message is the book tries to make this more comfortable for people. It's the old-fashioned, a spoonful of sugar helps the medicine go down. And again, you can relate to all the characters. It's just more palatable, a less intimidating way to get the information than using the ChatGPT or any of the other LLMs.
Okay, last thing, one quick piece of advice. First thing that you would recommend young people do.
I'm still the wealthy barber. It's got to be, it's got to be pay yourself first. I mean, I haven't deviated from that one central message, but I've shown people better ways to do it, more effective ways to get at it. But pay yourself first. One more. I love spending summaries. I did not do a good job in the original version of highlighting the importance of chronicling your spending and learning from those habits. Do that for sure.
Okay, David, thanks.
Good seeing you again.
Good to see you. That was David Chilton, author of The Wealthy Barber. Up next, we'll break down Walmart's latest quarterly results as the company plans to move its stock listing to the NASDAQ from the New York Stock Exchange. Stay with us. Walmart stock is surging today, one of the few companies doing so after the company announced it's raising its full forecast for the year after a strong quarter. But the company is also warning that prices will have to rise. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, thanks for joining us. And Walmart looking good right now. They're up, what we were looking at, I think almost 5%, 6% right now.
Almost 6%, yeah. So, I mean, and that's pretty good for Walmart. That's a stock that doesn't actually usually move that much throughout the year. It usually stays pretty stable. It's not usually very volatile. So to see it go up that much is quite a thing to see. But yes, there's a couple big announcements coming out today as Walmart announces its Q3 report, its earnings for this third quarter. But we'll start with the third quarter. Most are saying it was a strong third quarter. Walmart, as you mentioned, raising its annual outlook for the year. Net sales expected to rise by 4.8% to 5.1%. Revenue was up 6%, almost in line with estimates. Same-store sales was up. So was foot traffic, apparently, throughout Walmart. Some analysts saying that this is a conservative Q4. They expected better results given just how big the company is. And they say that this might be a sign of just consumer spending as we head forward, and we could see more signs of slower consumer spending as we head forward, because Walmart did say today that they're expecting prices to rise in the new year, and most of that is because of tariffs. Like most companies, Walmart has been absorbing the cost of tariffs, trying to offset it, working with suppliers to try to keep prices lower, looking elsewhere to source products if they need to keep prices lower. But the costs are apparently going up weekly as inventory from before the tariffs were imposed runs out, and they have to replenish that inventory with tariff-priced stuff. Yeah. And so Walmart's saying that, they can't continue to absorb the costs forever. And so this is what's going to happen. And Walmart, often a barometer for other, big retail stores. We saw Target say something similar. Other companies are also saying similar things. So potentially expect a price rise in 2026. Not sure how much, though.
Okay. All right. Well, we'll see what happens with that. And interesting thing, they're moving. Sort of. Sort of moving. Packing up the rags and leaving. Yeah,
it is interesting. That was the other big announcement that Walmart said. It is transferring the listing of its stock over to the NASDAQ, so New York Stock Exchange. Maybe not too happy with this, but it's
some money lost there.
It's really interesting to see a company do this. So they'll begin trading on December 9th on the NASDAQ. The current ticker will stay the same. The symbol will stay the same. And it's a move that really shows that the company is focusing on tech moving forward. No surprise, of course, Walmart incorporating AI into a lot of what it does, just like so many other companies, partnering with OpenAI so that people can start shopping through ChatGPT on Walmart. But we spoke with, I believe it was you actually that spoke with Teresa Schutt earlier today at Harborfront Wealth Management, and she was saying this decision just shows how much technology is embedded in the company. Here's more from her.
More than 40% of Walmart's new software code is now AI generated. And then obviously they've spent decades investing in automation, e-commerce. They're using agentic AI. So I think, maybe they want to just be considered another tech darling and get the benefit of that. But I do think, they are becoming more of a tech company.
And of course, Walmart has really been expanding when it comes to e-commerce shopping, 20% basically up across all the markets when it comes to e-commerce. And you think of like good prices, good value when you think of Walmart. We were talking earlier with the e-commerce side of things and the third-party buying platforms and shopping platforms. Walmart is able to offer things like a pre-owned Chanel bag is the example we're using today that you can find on Walmart's website. So weird, so interesting to see that. But really, they're bringing in a new kind of like clientele and people people of different incomes, because oftentimes with those lower prices, more low-income shoppers can shop there. But the CFO of Walmart did say they do anticipate a slowdown in spending with more low-income households. So maybe this is a way to prepare for that.
All right, Lindsay, thank you for that.
Thanks.
BNN Bloomberg's Lindsay Biscay. Now time. Earlier, we zeroed in on 3 plays in basic materials. We were joined by Seth Goldstein, senior equity analyst at Morningstar Research, who had Albemarle as his top pick. He says the company should benefit from rising lithium prices.
We still think there's a lot of upside, despite the fact that the stock has seen a pretty large rally from its recent 52-week low. And the rally's been driven by rising lithium prices. So since about the middle of the year, since early July, we've seen lithium spot prices in Asia, the largest battery market, start to rise. And while we still think they have much further to go, the rise has been enough for Albemarle to start improving its results. So when they released their third quarter earnings, we saw the company did see lower lithium prices, but they had lower unit production costs, which drove profit growth, and they generated positive free cash flow. And that is a sign that Albemarle is a low-cost producer. We have a narrow moat rating on the name because of its low-cost lithium assets. And so we think they can get through the bottom. And as prices continue to rise, they'll be one of the largest beneficiary as we see lithium demand growing faster than supply over the next coming years.
Partly because of electric vehicles and I guess large-scale energy storage, too.
It is. So we're seeing global EV sales continue to grow. And even though we expect that we'll see the U.S. EV sales fall next year as the tax credit expired in September, we do think globally we'll continue to see growth in key markets such as China and Europe. And so for lithium demand, it just matters that EV sales are growing globally. And then we're seeing the large utility scale energy storage batteries. These are being built to accompany solar and renewable projects. These are also being built in data centers to ensure grid reliability in new data centers. So here is a new case that's the fastest growing demand source for lithium. And as we've seen prices fall over the last few years, there's been a lot of supply cuts in response. And so now the market's going to move into balance due to the strong demand growth.
Your next idea, Nutrien, they are going through a pretty aggressive restructuring actually right now, selling off some important assets. Is that part of your bull case on the stock?
It is. We value Nutrien at $70 for the U.S. shares, and so we see a good upside to the current levels. And we think Nutrien's management is running the business very well. We like to focus on free cash flow generation. We like to move to divest retail assets and smaller businesses, smaller fertilizer mines in South America, where they tried to expand in that market to take advantage of demand growth from farmers, but they realized the returns weren't quite there. It wasn't as good of an investment as their expansions and their North American assets, both on the retail and fertilizer side. And so we credit management with being willing to walk away, divest assets, and put the cash flow either to share repurchases or to better investment projects in North America. So the company is underway divesting some South American assets. They're also reviewing their phosphate business, which has been one of the smallest businesses for Nutrien since the company was created years ago. But we do think that this business is less profitable, likely generates less free cash flow. And if they sell the business, they could use the proceeds elsewhere. So we like the move to at least review the future of the business.
It's interesting. The Globe and Mail reports today that Nutrien has selected a port in Washington State for a new export terminal worth up to $1 billion. Of course, that would be a blow to our government, which is trying to get infrastructure built in this country. We're trying to check whether Nutrien has actually done that or made an announcement. Finally, Qnity, and I hope I've said that right. I never can remember the pronunciation, but they make materials for the semiconductor industry.
That's right. So Qnity, and you did pronounce it right, was recently spun off of DuPont, and it's DuPont's semiconductor and electronics business. 2/3 of what they make are the chemicals and materials that you need to make semiconductors, and the rest is the chemicals and materials that you need for printed circuit boards to ensure things like our phones can connect to the internet, or in a data center that the devices throughout the center can have high connectivity so the data center functions really well. So these are very crucial materials. As we see globally, more data centers will be built out, phones will need increased connectivity over time, and we're going to see the need for more semiconductors and more powerful semiconductors. So we value Qnity at about $100 a share, so we see good upside to the name, and we think they are one of the leaders in these advanced materials and chemistries needed to support this demand growth, to support more smaller, more powerful chips, which do require better chemicals and better materials over time. So we think this is a good long-term growth, a good way to invest in rising semiconductor demand and increased connectivity over the years.
It is amazing the level of technology that the chip people are reaching right now, the tiny scales that they're operating at.
It really is. And TSMC is going to come out with transistors that are just 2 nanometers large, which continues to get smaller and smaller and more powerful over time, which makes our phones work better, allow us to do more as consumers. We ultimately get the benefit, even if we will be paying up for our future phones. But for a company like Qnity, they are working hand in hand with companies like TSMC and Intel to ensure that they can produce these chips and do so at good yields.
And he was talking with Seth Goldstein, senior equity analyst at Morningstar Research. Still ahead, today's Market Movers with Bloomberg's Matthew Griffin. All right, let's take a look at some movers south of the border on an interesting day. We are joined now by Bloomberg Equities reporter Matthew Griffin. Matthew, thanks as always joining us. Block is trying to own the block by the looks of it. It's looking good right now.
Yes, Roger, thanks for having me. And Block is swimming against the current here. The shares are above water on a day that just keeps getting worse in the broader markets, up just under 2%. The financial technology company said yesterday that they see their gross profit accelerating over the next 3 years, and also gave a bit more of a long-term outlook for the business. They say they want to launch products faster. They want to better integrate Cash App, which is their consumer business, with Square, which is focused on merchants. So the stock rose more than 7% yesterday, extending those gains a bit today. Now, you look at the year-to-date stock chart, it's still not pretty. They're down about 25%. You've had a whole host of problems there, some results and guidance that disappointed investors, concerns about growth at Cash App, and concerns about the broader economy. I mean, this is a business that relies on consumers' spending, and consumers have been under pressure this year. We've had tariffs. We've had other questions about the strength of the job market. So right now, this hasn't fully turned around investor sentiment on the company, but it's keeping them above water today. Shares up once again yesterday, and just a bit of a glimmer of optimism here after a tough year.
Yeah, I was just looking at the quote from their chief financial officer, Amrita Ahuja, saying, we've made deliberate choices to run our company differently, run them as one company, and that has transformed us. That's quite the statement to make.
Yes, and probably something that investors were looking for a bit of a refresh. Cash App's user numbers were really stuck for a few quarters, about 57 million users. They've picked up again in recent results, but you see investors really looking for something new there, for ways to grow the business that they can get excited about, and maybe that commentary is helping a bit here.
All right, Bath and Body circling the drain right now. They're in a rough spot.
Yes, that's just the opposite situation to Block. They're down about 26% today and bringing a year-to-date slide to about 60%. The home products retailer said that they now see sales shrinking this year. They previously saw them growing 1.5 to 2.7%. They now see a low single-digit drop, which actually implies an even worse drop in the fourth quarter. They see consumers under pressure. You have incomes that were disrupted for government employees. You have people just generally concerned about job stability. On the flip side, they did lay out a plan to turn things around. They said they want to focus more on their core business. However, that clearly has not eased investors' concerns. Over at Bloomberg Intelligence, one of my colleagues says that plan lacks specifics and that the company is really going to have to execute quickly if they want to win confidence back. So I think the next thing for investors will be, how does that turnaround effort go from here?
Okay, we got about 30 seconds. What do we see with GE Vernova? What happened with them?
This is a power equipment stock that I watch really closely, and it's been bouncing today. It rose tracking NVIDIA. Now it's down again. It just goes to show how many stocks trade on the AI thesis. They sell gas turbines, wind turbines, seen benefiting from a boom in power demand. And that means that as their shares go, power demand from AI, so as the shares of AI companies like NVIDIA go, so goes GE Vernova. That's been the story today. Pulling on the shares today.
I got to cut you off there. Matthew, thank you as always. Bloomberg's Matthew Griffin. That wraps up this edition of Trading Day. I'm Roger Peterson. Thanks for joining us.